I'm going to give you a hypothetical scenario, but one that's somewhat typical of what we might see. A retired couple, married, both age 66, and they need $100,000 per year of cash flow. They've both decided to delay their Social Security benefits until age 70 because they expect to live a long time. And at that age, they've calculated their combined benefits to be about $65,000. Their portfolio is pretty straightforward. They've got $600,000 in a 401k plan and $600,000 of low basis stock in their personal account. Now, this is stock they've owned for many years that's grown considerably in value. So that's it. No money in Roths, no bonds, just $600,000 in their 401k and $600,000 in their personal brokerage account. Now, again, they're retired and they need $100,000 per year. Now, how is it possible for them to take that income from these two accounts and pay no federal income tax? Well, let's take a look. The first thing they need to do is take $30,000 out of their 401k. But you might ask, isn't any money that comes out of a 401k taxable at ordinary income rates? Well, yes, but in this case, that ordinary income is offset by the $30,700 standard deduction. So in essence, that money comes out tax-free. Now, of course, that still leaves us with $70,000 of income that the couple will still need for the year. Now, how could that possibly come out tax-free, especially when they don't have a Roth? Well, here's how. They turn to the $600,000 of low basis stocks in their personal taxable brokerage account, and they sell $70,000 of those stocks. How is that tax-free? Because a married couple filing a joint return with income of no more than $89,250, including the capital gain, is in the 0% long-term capital gain tax bracket. They only took out $70,000, and not even all of that is taxable. Remember that they're selling stock that they've owned for a long time, and that creates a long-term capital gain. And at this level of overall income, the long-term capital gain rate is 0. So there it is. $30,000 comes out of the 401k tax-free, thanks to the standard deduction, and $70,000 comes out of the brokerage account, also tax-free because of the 0% capital gains tax rate. They've got their $100,000 of income from their two accounts, and they paid no federal income taxes on that money. Now, it's important to keep a couple things in mind here. First, this is just an illustration to show how an account that you think is taxable, like a retirement account, may not be taxable to you at all when you're properly distributing the assets. Second, while this may seem to go against the concept of the bucket strategy, which spends safe money first, it can be done as part of a properly managed bucket strategy. And all the Lucia Capital Group advisors are trained to do exactly that. Okay, so what does all this mean to you? First, it demonstrates the importance of tax management. Any money that our couple took out of their 401k that exceeded the standard deduction would have been taxable. By stopping at the standard deduction amount, it was all tax-free. And by taking no other income except the long-term capital gain they created by selling stock from their personal brokerage account, they were able to stay in the 0% capital gain tax bracket. It also shows how it's helpful to have different silos of money with different tax treatments. Having a combination of pre-tax, tax-deferred, and tax-free money potentially gives you some really good planning options. And finally, it shows that you don't have to limit yourself to the 4% withdrawal rate in every situation. Our couple was able to take out a little more than 8% from their portfolio for the first 4 years because they knew they would have Social Security coming in at age 70 when their withdrawal rate would go back down to somewhere between 4 and 5%. Tax management, variable sources of income, asset location. These are the kinds of strategies we use for our clients every single day here at Lucia Capital Group. How can we help you the most? Just give us a call.